As I like to tell people, if you're not feeling confused, it probably means you're not paying attention right now. There's so many different cross currents. And it's a time when very smart people can look at the same data and come to just wildly different conclusions. And I know that can be really frustrating for the average person who's just trying to make sense of all this, when even the supposedly smart people don't seem to see eye to eye. And what I'm increasingly hearing sort of from the synthesis of all those people that I talk to, or at least what I've taken away from all those conversations is I think there are reasons to be concerned in the near term about more disruption, more market volatility. A lot of people think, we had that big market drop in April, but that's ancient news now, and now we're back to the races and everything should be fine. I don't think that volatility is over. And I think we are entering an era where that disruption and that volatility is going to create some real winners and losers, I think on a much more permanent basis than we've seen in a good while. And I'm happy to kind of peel back the onion on each of those things. From an economic standpoint, I think that, right now we have interest rates, bond yields, that they went higher than most people thought they were going to be able to, and they remain there for a lot longer than folks thought they were going to be able to. And that's the higher that interest rates go, the higher that bond yields go. That's just like gravity on the economy. And so the longer we hang out there, it's like just the more gravity has a chance to try to pull economic activity downwards. And we're seeing lots of signs that the economy is slowing. And, it's not just the interest rates on corporate debt out there. We're seeing it sort of everywhere, right? So everyone who's been paying attention to the headlines knows that interest service payment as a percent of the deficit or budget has dramatically increased over the past couple of years, now exceeds what we're spending on national defense, or it did. I guess we just bumped up defense, but it's going to be pretty close again to being larger than defense. We're certainly seeing it in corporate America as more and more companies that loaded up on cheap debt prior to the Fed starting to raise interest rates, that debt is increasingly coming up for renewal. So that means that companies have to refinance their debt. It's now going to be at a much higher rate. And so that eats into profits, right? There's just less left over for reinvestment into the company or paying out as profits. We're seeing the same thing happen at the household level, right? Where mortgages are 7% still. Right. And so that basically has kind of strangled the ability of aspirational home buyers to be able to afford a house. And we're seeing that on just all sorts of consumer debt, right? Like 20% APR credit cards. So, all of this higher for longer debt just acts as additional weight pulling the economy downward, right? I can go a lot deeper into that, but I think just to kind of give you my long-term view is I think in the short term, we're going to see that continue to slow the economy. We're going to see repercussions of that. I think that's then going to reflect in the markets, where the markets are going to have to reprice, because right now they're priced for perfection, maybe even some cases better than perfection. So that's going to have to reprice. That'll return that market volatility that I talked about. So I could see it being kind of rough, at some point over the next 6 to 9 months or so as those things really begin to manifest. At some point, we're going to see the cavalry ride to the rescue as these business-friendly policies that the Trump administration has been pushing through, those are going to start to bear fruit. And we're going to start to see increased CapEx coming as part of that. We're going to see some of the benefits of these trade deals, hopefully. We're going to see the benefits of the deregulation. So I actually am kind of fairly optimistic, kind of in the midterm. But then I think in the long term, we are headed towards a system where the benefits of a lot of that golden age, if it indeed does materialize, I think are going to accrue to a smaller and smaller number of players, especially as AI really begins to make itself felt. And so we may see an era where overall the economy grows, corporate profits grow, but they're increasingly concentrated in a smaller number of the really big players that can afford to really deploy AI at scale. And so it's not going to be sort of widespread across the general economy, and it's going to increasingly be at the cost of labor. And so I do have a hard time as seeing this AI revolution as anything but a massive jobs killer at scale. And while that might be good for the big hyperscalers in our economy, it could be very, very bad for the wide masses of rank and file employees. So we can talk about that, but I kind of wrap all this up by saying, we have increasingly been on the trajectory of having a K-shaped economy. And I think you and I have talked about that in the past. I think most viewers know what I mean, where the smaller upper half of the K has been doing increasingly well, while the larger bottom half of the K has been struggling. I see us moving fully towards an I-shaped economy. And by I-shaped, think of like the letter I, where it's a little dot. It's a little small group of elites that are prospering and protected at the very top. And then everybody else below them is increasingly struggling. I fear that that's where we're headed over the long run. But I think the way we get there, like I said, is maybe some short-term, turbulence, maybe, some midterm, sense of, hey, we made it through and things are getting better. But then we realize, well, wait a minute, actually all these benefits are going to very few people at the top. And increasingly the rest of us are getting left out of the party. From an economic standpoint, I think it is fair to say that the playbook that Trump is following, which borrows heavily from the Reagan playbook, has a more demonstrated history of resulting in, nearer term, a higher economic growth, right? And of course, the playbook there is, hey, if we just sort of let the government get out of the way and everybody gets to keep a greater percentage of their profits, and there's a higher profit motive here, and there's less, regulation getting in the way, we're going to grow the pie and everybody's going to benefit more on average. And to be honest, I think if you compare that to a lot of the other playbooks from a lot of other administrations since the Reagan era, there's, I think, a pretty good argument to be made for that. We did have too much regulation. We probably did let too much concentration happen, and in the emergence of cartels, the government probably did get too involved in a lot of industries and making them less efficient and driving up costs. The list of that is long: healthcare, education, whatever, you keep going through it. So I think the argument the administration is making that, hey, if the output of all this stuff that we're putting in place should result in higher economic growth than otherwise. I think that's a fair argument. Will it materialize? Who knows? We're still in the middle of, the whole tariff thing, and will tariffs be inflationary or not? Are we actually going to get better trade deals with our partners and grow our overall trade? Or are we, angering the rest of the world and, driving everybody into China's arms and, all that stuff? I actually think that Trump has been a lot more successful to date than most people expected he would be. I think that trend will probably continue until we have evidence that it doesn't. So I would say this, discount that if your blanket assumption here is he's just screwing everything up, he's a bull in a china shop breaking everything, and the economy is going to be, worse as a result. That might happen. But I think looking at the data that we've now increasingly seen over the past 6 months, I think things tend to increasingly be going his way in terms of where he's wanted them to go. And so if your default assumption is he's going to screw this up, you should at least have a plan B in place in case your primary hypothesis is wrong. We will hopefully see corporate profits continue to sustain and maybe rise from here, even though they are at all-time highs. But who knows? This AI revolution may actually bring us to a new higher level of corporate profitability than we had before. That in theory should benefit, the workers of those companies. They should want to hire. There is going to be, I think, a real boom in hiring for the trades as we do a lot of the infrastructure build out that this administration is prioritizing, both in AI with, zillions of data centers, but certainly in the energy and the natural resources space. So it's not all doom and gloom here, especially not in the near to midterm, as I think, right now there are literally millions of trades jobs that are unfilled right now that we need people for. We literally cannot find enough skilled tradesmen right now. So there is a decent story to be told here. Now, there are all sorts of questions that get raised about, all right, but what happens with the debt and the deficits, in the long run? The one big beautiful bill didn't go nearly as far enough as a lot of people would have liked it to see to get deficit spending under control. As you and I have talked about, that's really the meta risk here, which is that we keep spending beyond our means, the debts continue to balloon out of control. And the only way to deal with that in the long run is to devalue the cost of the currency, making everything, basically much less affordable for the average person as the value of their money gets frittered away. And, we end up in this two-tier class system that I'm talking about, this sort of I-shaped economy, where those at the top who own all the assets and the means of production get all the benefit, and everybody who can't keep up falls below. I think cyclically, this is a really good time to be a natural resource investor. And if any of your listeners have been invested in gold, silver, uranium, et cetera, over the past year or two, they understand that this is finally back into a bullish upcycle after a long time in the wilderness. And there's still potentially an awful lot of room to run here. One, just sort of technically and cyclically, if you look at the ratio of the S&P 500 to the commodity complex, we're still kind of plumbing historic lows, like decadal lows. So that's going to revert to the mean in some way, shape, or form going forward. But also, as I mentioned, with this particular administration, we've got such a difference from the previous one in terms of, prioritizing drill baby drill, mine baby mine. So much of the build out here that's going to happen, all that's going to need natural resources. We've also decided we're going to rely less on the rest of the world for the natural resources we used to get from them. So rare earths from China is a great example of that. So it's just a very good time to be or prospects look very good for this space going forward. I'd say at a high level, beyond just that, at the end of the day, it's our national profligacy that's going to get us. And it's not just the US with this problem, it's everybody else, all other countries too, pretty much. So just, the confidence that in the long run, the purchasing power of fiat currencies is going to trend towards zero. And what are the ways in which we as awake and aware investors can put ourselves in front of that to at least not get steamrolled by it and hopefully in certain cases prosper.